Are we on the brink of a financial meltdown in 2025? With inflation still high, interest rates climbing, and global instability shaking markets, investors are bracing for impact. In this video, we're diving into 4 major concerns that could signal a recession and what it means for your investments. 1. Rising inflation and interest rates. What's the biggest threat to the economy right now? Inflation and the Federal Reserve's aggressive rate hikes. Despite efforts to cool the economy, inflation remained at 5% in late 2024, far above the Fed's 2% target. As a result, mortgage rates surged to their highest levels in over 2 decades, slowing home sales by nearly 20%. The real estate and tech sectors felt the impact, with home builders like D.R. Horton struggling and tech companies facing tighter financing conditions. If the Fed keeps raising rates, borrowing will only get more expensive, slowing business expansion and consumer spending. This could tip the economy into a recession, bringing volatility to interest-sensitive stocks like real estate and utilities. The key question: will the Fed go too far and trigger a downturn? 2. Slowing corporate earnings and profit margins. Could corporate profits collapse in 2025? Earnings growth has already slowed in major sectors like retail and tech. Amazon's Q4 2024 earnings disappointed investors, with e-commerce sales stagnating and its stock plunging 15% overnight. Companies like Apple and Microsoft, which thrived during the pandemic, are now facing rising costs and weaker demand. Higher operating expenses and declining consumer spending are squeezing profit margins, forcing businesses to cut costs or raise prices. Even companies like Coca-Cola, which have increased prices to offset inflation, are seeing slower sales growth. If a recession hits, corporate earnings could take a massive hit, dragging stock prices down with them. If you're getting value from this video, hit the like button to help us reach more investors. Also, if you want our top stock picks that perform in any market, click the link in the description to get our next recommendations. 3. Global instability and geopolitical tensions. From trade wars to political instability, global risks are mounting. The ongoing war in Ukraine has driven up energy prices, worsening inflation across Europe. Supply chain disruptions are hitting manufacturers like Ford and General Motors, while rising geopolitical tensions between the US and China could further weaken global trade. If conflicts escalate or sanctions intensify, markets could react sharply, leading to a global sell-off. Sectors like shipping, manufacturing, and technology are particularly vulnerable. The world economy is interconnected, and one major crisis could send ripple effects through every market. 4. Rising unemployment and consumer confidence. One of the clearest signals of a recession is job losses, and we're already seeing early warning signs. Tech giants like Meta and Alphabet have laid off thousands of employees, creating uncertainty in the job market. When consumers feel insecure about their finances, they cut back on big-ticket purchases, hurting businesses that rely on discretionary spending. Retailers like Walmart and Target are already seeing slower sales growth as inflation eats into household budgets. If unemployment rises, consumer confidence could plummet, dragging the economy down even further. Recession fears are growing, and investors need to stay prepared. With inflation, rate hikes, corporate struggles, and global uncertainty all in play, 2025 could be a volatile year for the stock market. However, opportunities still exist. Certain defensive stocks and long-term growth industries could thrive despite the downturn. The key is staying informed and strategically positioning your portfolio. Watch the next video to see the momentum strategies we're using to navigate this market.